What if the most powerful retirement tool you've never heard of could erase every tax you pay on your savings? Most people overlook it, and the tax savings are staggering. Imagine an account that lets you contribute pre-tax dollars, grow those dollars without ever seeing the IRS, and withdraw them tax-free for a purpose you already pay for every day. That account exists, and it's called a health savings account, or HSA. You've probably heard the term tossed around in financial podcasts, but you might still be thinking it's only for paying doctors' bills. In reality, an HSA can be the crown jewel of a retirement strategy for anyone who qualifies. It does everything a 401k does, and then some. It's the only account in the United States that offers a true triple tax advantage. By the time we're done, you'll see why the HSA can outpace a 401k for eligible earners, and how a simple shift in mindset can turn a health expense account into a tax-free investment machine. Let's set the stage. Most Americans spend their working years funneling money into a 401k or an IRA, hoping to build a nest egg for the golden years. The logic is simple. You defer taxes now, your investments compound, and you pay tax on withdrawals later. For many, that plan feels solid. Yet the 401k has hidden costs that most people ignore. Every dollar you contribute is subject to payroll taxes, Social Security, and Medicare right at the source. Your earnings grow tax-deferred, but when you finally tap the account, the entire balance is taxed as ordinary income. And after age 72, the government forces you to take required minimum distributions, even if you don't need the money. Those are 3 layers of tax erosion that can shave thousands, even tens of thousands, off your final balance. Now picture an account that sidesteps each of those layers. An HSA lets you put money in before any federal income tax or payroll tax is taken out. It lets that money grow completely tax-free, just like a Roth IRA. And when you finally withdraw the cash for qualified medical expenses, the withdrawal is also tax-free. No taxes ever touch those dollars as long as you stay within the rules. That's the triple tax advantage: pre-tax contributions, tax-free growth, and tax-free qualified withdrawals. Here's a quick reality check. The average 401k holder pays about 20% in taxes over the life of the account, according to a recent analysis by the National Bureau of Economic Research. In contrast, an ASA can keep 100% of its earnings in your pocket. That difference alone can turn a modest $300,000 retirement balance into nearly $400,000 simply by avoiding taxes. That's a real, tangible boost that most people never consider. So, who can actually open an HSA? The eligibility rules are stricter than a regular savings account, but they're not as restrictive as they sound. You must be enrolled in a high-deductible health plan, or in 2024, the IRS defines a high-deductible plan as one with a deductible of at least $1,600 for an individual or $3,200 for a family, and with out-of-pocket maximums no higher than $8,050 for an individual or $16,100 for a family. If your employer offers a plan that meets those thresholds, you qualify. Even if you're self-employed, you can purchase an HSA on the individual market and still open an HSA. The key point is that the HSA requirement isn't a barrier for most working adults. It's simply a different type of health insurance that many large employers already provide. You might wonder, why would anyone choose a high-deductible plan over a low-deductible one? The answer lies in cost. You usually have lower monthly premiums, sometimes dramatically lower. For a family of 4, the premium difference can be a few $100s per month. That saved premium can be redirected straight into an HSA, creating a virtuous cycle of savings. In other words, you trade a higher out-of-pocket expense for lower regular costs, and then you fund those future expenses with tax-free dollars. It's a financial lever that many overlook. Let's talk numbers. The contribution limit for an HSA in 2024 is $4,150 for an individual and $8,300 for a family. If you're 55 or older, you get a $1,000 catch-up contribution. Compare that to the 401k limit of $23,000 plus a $7,500 catch-up for the same year. At first glance, the HSA limit looks tiny, but remember the tax advantage. Every dollar you put into an HSA avoids both federal income tax and the 7.65% payroll tax. If you're in the 24% federal bracket, that's a 31.65% effective tax saving on each contribution. Put $4,150 into an HSA, and you effectively keep an extra $1,313 that would otherwise vanish to taxes. Now imagine you invest that $4,150 each year and you earn a modest 6% return. Over 30 years, the balance would grow to roughly $400,000, all tax-free. If you had placed the same $4,150 into a traditional 401k, you would have paid tax on the withdrawal. Assuming a 24% tax rate at retirement, you walk away with only about $304,000. That's a $96,000 difference, solely from the tax treatment. And that gap widens if you're in a higher tax bracket now or later, or if you achieve higher investment returns. The HSA's investment options have expanded dramatically in the last decade. When HSAs first appeared, most providers only allowed you to keep the cash in a low-interest account, similar to a checking account. Today, the big players Fidelity, Lively, Health Equity, and others offer brokerage windows where you can buy stocks, index funds, even mutual funds. Some providers let you set up automatic contributions from your paycheck, just like a 401k. Others let you roll over unused funds from an old HSA into a new one without tax consequences. The flexibility is comparable to a brokerage account, but the tax shelter remains. One clever strategy is to use the HSA as a medical Roth IRA. Here's how it works. During your working years, you pay for routine medical expenses, copays, prescriptions, even dentist visits out of pocket. You keep all receipts because the IRS allows you to reimburse yourself later, tax-free, for any qualified expense incurred after the HSA was established, even years later. You let the HSA balance sit untouched, fully invested, for decades. Then, after age 65, you can withdraw the money for non-medical purposes without the 20% penalty that applies to younger withdrawals. You'll still pay ordinary income tax on non-medical withdrawals, but you can treat the HSA like a traditional 401k at that point. The real magic is that for all qualified medical withdrawals, whether they happen now or 10 years from now, you never pay a cent in tax. Consider a real-world scenario. Sarah, a 35-year-old software engineer, enrolled in an HSA that saved her $200 a month on premiums compared to her previous plan. She opened an HSA and contributed the maximum $4,150 a year. She paid her $1,500 annual deductible out of pocket and saved all her receipts. She invested the contributions in a low-cost S&P 500 index fund, averaging 7% annual return. Fast forward 30 years, Sarah's HSA balance sits at $530,000. She's now 65, and she decides to use $100,000 to pay for her mother's long-term care, a qualified expense. That $100,000 leaves the account tax-free, leaving $430,000 still growing. If Sarah had put that same $4,150 each year into a traditional 401k, assuming the same return, she'd have about $400,000, but every dollar withdrawn for medical costs would be taxed as ordinary income. In Sarah's case, the HSA gave her an extra $130,000 in tax-free purchasing power, plus the peace of mind that she could cover unexpected health costs without dipping into other retirement savings. What about the dreaded penalty for non-qualified withdrawals before age 65? The rule is simple. You pay a 20% penalty plus ordinary income tax on the amount withdrawn. That sounds harsh, but most savvy HSA owners never need to touch the account for non-medical reasons before 65. They treat the HSA as a long-term investment, just like a retirement account, and only use it for qualified expenses, anything from insulin pumps to vision correction surgery. The penalty serves as a deterrent, ensuring the account stays intact for its intended purpose. And after 65, the penalty disappears entirely. You can now treat the HSA as a regular taxable account for non-medical expenses, just like a 401k. The only remaining advantage is the tax-free growth and tax-free withdrawals for qualified medical costs. Let's dig deeper into the qualified medical expense definition. The IRS publishes a comprehensive list in Publication 502. It includes everything you'd expect: doctor visits, hospital stays, prescription drugs, mental health counseling, but also less obvious items like acupuncture, hearing aids, and even certain over-the-counter medications if prescribed. Even the cost of a home blood pressure monitor qualifies. The list also covers insurance premiums in specific circumstances, long-term care insurance, COBRA continuation coverage, and health insurance while receiving unemployment benefits. The breadth of the list means you can often find a qualified expense for almost any health-related outlay, turning everyday spending into a tax-free withdrawal. Now, you might be thinking, what if I never have large medical expenses? Isn't the HSA just a waste? Not at all. The power of the HSA lies in its flexibility. You can reimburse yourself years later as long as you have the receipts. That means you could let the account grow untouched for decades, then pull out a lump sum to cover a major surgery, a child's orthodontic work, or even to fund a retirement hobby. Any qualified expense you can document. Because you can reimburse yourself retroactively, you can essentially bank the tax savings now and cash them in later, when you need them most. It's like having a secret stash of tax-free money that you can unlock at any point in the future. Another often overlooked advantage is the impact on your overall tax planning. Since HSA contributions are deducted from your taxable income, they can lower your adjusted gross income a year. That reduction can make you eligible for other tax credits and deductions that have income thresholds, such as the child tax credit, the saver's credit, or even lower your Medicare premiums. In other words, the HSA doesn't just give you a direct tax break. It can cascade into additional savings across your entire financial picture. Let's compare the HSA to the 401k side by side on 3 key dimensions: tax treatment, contribution flexibility, and withdrawal rules. Tax treatment. HSA contributions are pre-tax, growth is tax-free, withdrawals for qualified expenses are tax-free. 401k contributions are pre-tax, growth is tax-deferred, withdrawals are fully taxable. Contribution flexibility. HSA limits are lower, but you can make contributions at any time of the year, even after the tax deadline, as long as you remain eligible. 401k contributions are generally limited to payroll deductions and must be set up before year-end. Withdrawal rules. HSA withdrawals for qualified expenses are penalty-free at any age. Non-qualified withdrawals before 65 incur a 20% penalty. After 65, non-qualified withdrawals are taxed like a traditional 401k but without penalty. 401k withdrawals before 59.5 incur a 10% early withdrawal penalty plus tax. After 59.5, withdrawals are taxed as ordinary income, and after 72 you must take RMDs. A striking retention bump. Did you know that the average 401k investor ends up paying roughly $30,000 in taxes over a 30-year horizon just because of the tax on withdrawal rule? That number is higher than the average cost of a new car. The HSA can eliminate that entire tax bill for the portion of your savings it holds. That's a concrete, eye-opening figure that puts the advantage into perspective. Now let's explore a common misconception. Many people think they can't have both an HSA and a traditional health plan. The truth is, you can have a health reimbursement arrangement HRA that works alongside an HSA, provided HRA is limited purpose. In a limited purpose HRA, the employer can reimburse only dental and vision expenses, leaving the medical expenses to be covered by the HSA. This arrangement allows you to maximize tax-free contributions on both fronts. It's a sophisticated strategy that high net worth individuals use to squeeze every possible tax advantage out of their compensation package. There are also strategic timing moves you can make with the HSA. Suppose you anticipate a major medical expense next year, knee surgery for instance. You could front-load your HSA contributions for the current year up to the annual limit, and then use the funds tax-free when the surgery occurs. Because the contributions are pre-tax, you reduce your taxable income for the year you earn the money, not the year you spend it. This forward-looking approach can be especially powerful if you expect your income to rise in the coming years, pushing you into a higher tax bracket. By contributing now, you lock in the lower tax rate. Let's walk through a detailed example that ties all these ideas together. Imagine James, a 45-year-old accountant earning $120,000 a year, married with 2 kids. He currently has a 401k balance of $250,000, contributing the maximum $23,000 per year. He also has a traditional health plan with a $1,500 deductible. James is considering switching to an HSA that lowers his monthly premium by $150 but raises his deductible to $3,000. He calculates that the premium savings amount to $1,800 per year. He decides to open an HSA and contribute the full $8,300.